California's real estate market is rumbling, and not just from tectonic plates. As we head through 2025, some of the Golden State's most in-demand cities are rapidly losing heat. Home prices are dropping, listings are piling up, and, for the first time in years, buyers are starting to call the shots. So what's really going on? Which cities are seeing inventory skyrocket? Where are homeowners slashing their asking prices like it's a Black Friday clearance? And could that dream home you've been eyeing suddenly lose $50,000 in value? From buzzing tech corridors to sun-soaked coastal towns, this video breaks down the 10 California cities where home values are projected to take a serious hit in 2025. Number 10. Los Angeles. The city of angels has long dazzled with its palm-lined boulevards, iconic hillside mansions, and that unmistakable Hollywood allure. But in 2025, the shine is starting to fade, at least when it comes to real estate. Beneath the glitz and glam, LA's housing market is losing steam, and fast. Median home prices across Los Angeles County are still hovering around $850,000, but the numbers are starting to dip. In some neighborhoods, prices have fallen between 2% and 4% compared to last year. That may sound minor, until you realize that just a 2% drop on an $850,000 home means about $17,000 gone in value. What's even more telling? Inventory. The number of homes on the market has jumped over 50% year over year. That means more properties are sitting unsold, while fewer buyers are stepping up to make offers. Sellers are feeling the pressure. Over 40% of listings in early 2025 included price cuts. Just 2 years ago, that number was nearly half, around 22%. And it's not just the ultra-luxury spots like Beverly Hills seeing this shift. Even once hot middle-market neighborhoods like Northridge, West Adams, and Eagle Rock are cooling down. Buyers in these areas are coming in strong, negotiating hard, and often closing for less than the asking price. So what's causing the slowdown? One major culprit: mortgage rates. With 30-year fixed rates hovering between 6.8% and 7%, the average monthly payment on a typical LA home with 20% down has soared past $5,500. Just a few years ago in 2020, that same payment was closer to $3,800. That kind of jump has pushed a huge segment of potential buyers out of the market, especially as inflation drags on and job security wobbles in key LA industries like entertainment, tech, and media. Then there's the insurance issue. In wildfire-prone areas, major providers like State Farm and Allstate have started pulling back or pulling out altogether. That's made home insurance harder to secure and way more expensive when you can get it. In some cases, homeowners are paying hundreds or even thousands extra per month just to stay covered. Affordability? Practically gone. The bottom line? LA still looks picture-perfect on the outside, but behind the scenes, the housing market is cracking. With higher costs, fewer buyers, and swelling inventory, Los Angeles might be headed toward a very real correction, and in 2025, it could become a cautionary tale in California real estate. Number 9. Stockton. Stockton's housing market has never been known for stability. It's more like a roller coaster with sharp climbs and even steeper drops. During the 2008 financial meltdown, this city was one of the hardest hit. Home values were slashed in half, and at one point, Stockton even declared bankruptcy. Fast forward to 2025, and while things may look steady at first glance, familiar warning signs are starting to appear. The median home price recently topped out around $480,000, but in just the past few months, values have already dipped by about 3%. And according to some real estate analysts, that could be just the tip of the iceberg. Inventory has jumped significantly. Listings are up over 45% compared to this time last year. Meanwhile, homes are taking longer to sell. The average days on market has stretched from 27 to 44 in just 12 months, giving buyers more breathing room to think and negotiate. Sellers are responding in kind. Nearly 38% of all active listings in Stockton are now showing price reductions, nearly double the national average. So while this isn't a full-blown crash yet, the momentum has clearly shifted. What's driving the change? A big factor is Stockton's recent pandemic-era boom. When remote work became the norm, Bay Area buyers flooded inland markets like Stockton, drawn by bigger homes and lower prices. But now, As companies tighten remote policies and bring employees back to the office, that wave of migration has started to slow down. And with mortgage rates hovering near 7%, plus stricter lending standards, the path to homeownership is becoming more challenging, especially for first-time buyers. Then there's the local job market. Unemployment in Stockton remains roughly 7% higher than the state average, and wage growth still lags behind California's major metros. Layer on rising property taxes and climbing insurance premiums, and it's no surprise that affordability is taking a major hit. Many residents simply can't afford to jump into the market, especially younger buyers who are now holding off, hoping for steeper discounts in the months ahead. If history has taught us anything, it's that Stockton tends to feel the highs and lows of the housing market more intensely than most cities. And while we're not seeing a collapse yet, all the indicators suggest this could be the beginning of another downer. Bottom line, Stockton's real estate heat wave is starting to cool, and 2025 could be the year this once hot market finally flips. Number 8. Riverside. For years, Riverside was seen as LA's more affordable cousin, a place where you could still buy a decent home without getting caught in a bidding war frenzy. But by 2025, even the Inland Empire isn't escaping California's shifting housing tides. Median home prices in Riverside County had recently hovered around $575,000. But now, prices are starting to ease back, down roughly 2.5% year over year, and many forecasts are hinting at more softness ahead. That may not sound major at first glance, but considering this region saw close to 40% appreciation during the pandemic housing surge, the shift feels significant. The biggest red flag? Inventory. The number of homes on the market has surged nearly 50% compared to early 2024. Homes that used to fly off the market in under 2 weeks are now lingering for over 40 days. And nearly 36% of active listings have already been marked down, a clear sign that sellers are adjusting to the new reality. It's becoming a buyer's market, and fast. Sellers are scrambling, while buyers are taking their time, running the numbers, and making more aggressive offers. And then there's the cost of borrowing. With mortgage rates sitting around 7%, the monthly payment on a $575,000 home now pushes past $4,300, and that's not even including property taxes or homeowners insurance. When you add in rising energy bills, ongoing inflation, and wage growth that's barely moving, many families are finding themselves priced out, or simply walking away from the idea of buying altogether. Investors, too, are feeling the heat. Many who jumped into Riverside real estate during the 2020 to 2022 boom are now looking to offload properties, in some cases at a loss, just to cut ties and move on. And while Riverside's proximity to LA has always been a selling point, it's no longer enough to overcome growing concerns. Traffic congestion has worsened. Wildfire risk is climbing. Public transportation is still lacking. And with new construction expanding on the city's outskirts, resale homes are facing stiff competition from brand new builds offering incentives and builder perks. The mood? Cautious buyers, stressed sellers, and a market that no longer feels urgent or hot. Riverside isn't crashing, at least not yet, but it's definitely cooling. And if this trend continues, 2025 could go down as the year the Inland Empire's real estate momentum finally hit pause. Number 7. Bakersfield. Bakersfield used to be California's poster child for affordable living. With median home prices hanging around $385,000, it became a haven for first-time buyers, retirees, and families fleeing the sky-high costs of cities like LA and San Francisco. But in 2025, even Bakersfield isn't immune to the growing tremors shaking up the state's real estate market. Home prices in the area have slipped by about 1.7% over the past year. Not dramatic on the surface, but it marks a clear shift. Inventory is also way up, climbing nearly 48% year over year. In short, the landscape is changing fast. But here's what makes Bakersfield different from places like Los Angeles or Silicon Valley. It's not a case of luxury overkill. The issue here is more sobering. What used to be affordable is no longer within reach for the average local buyer. Let's do the math. With interest rates holding steady around 6.8%, a 30-year mortgage on a $385,000 home now comes with a monthly payment close to $2,800 once you factor in taxes and insurance. And that's in a city where the median household income is still under $60,000. For many families, it simply doesn't add up. Add to that the rising cost of essentials, gas prices, inflation, and especially homeowners insurance, which has jumped following recent wildfires and prolonged drought conditions. The result? Buyers are pulling back, and sellers are feeling the squeeze. Nearly 35% of homes on the market are now seeing price reductions, and open houses that used to be packed now feel eerily quiet. The local economy isn't helping either. Bakersfield leans heavily on agriculture and oil, two sectors that are under growing pressure from state regulations and volatile global markets. That kind of economic uncertainty is pushing many would-be buyers to hold off or look elsewhere, even out of state, for more stable ground. The rental market, which used to attract investors in droves, is slowing too. Rents are leveling out, and homes aren't producing the returns they did a couple of years ago. Many landlords are backing out of bidding wars altogether or offloading properties they no longer see as viable long-term investments. So, no, Bakersfield isn't crashing, but it is cooling. And in 2025, affordability alone just doesn't seem to be enough to keep the momentum going. With cautious buyers, tighter budgets, and lingering uncertainty, the city may be facing more price drops before any kind of recovery takes hold. Number 6. San Jose. Once the crown jewel of California's housing market, San Jose stood tall as the tech-fueled powerhouse where prices soared, demand never seemed to cool, and million-dollar listings were the norm. But in 2025, even the heart of Silicon Valley is feeling the pressure, and it's starting to slow down. Home prices here recently peaked near $1.4 million, but early 2025 data shows signs of softening. Prices have dipped by about 1.2% to 2% year over year, and many analysts believe we're only at the beginning of a broader correction. What's causing the shift? Ironically, it's the tech sector itself, the same engine that once sent San Jose's market into overdrive. Layoffs at major players like Google, Meta, and other big-name firms have shaken buyer confidence. Add to that the evolution of remote work, with fewer employees rushing to live close to their company HQs, and that fierce housing demand is beginning to cool. Then there's the financing reality. With mortgage rates hovering around 6.9%, a $1.4 million home now comes with monthly payments topping $9,200 once you factor in taxes and insurance. And that's a heavy lift, even for those earning Silicon Valley salaries. Inventory is also on the rise, jumping nearly 35% year over year. Homes that used to fly off the market in under 10 days back in 2021 are now sitting for 35 days or longer. Nearly a third of all active listings are showing price cuts, and those legendary bidding wars that once defined the market, they're fading fast. To be fair, San Jose's overall wealth and strong economic base will likely prevent a full-blown collapse. But what we are seeing is a clear and steady correction. Even entry-level properties are being repriced to appeal to cautious buyers who are second-guessing every move in today's high-interest climate. In 2025, the San Jose housing market looks a lot more like a tech stock, high-priced, unstable, and no longer the guaranteed when it once was. If you're a buyer waiting on the sidelines hoping for a dramatic crash, you might be waiting a while. But what you will get is leverage, and in a city like San Jose, that's something we haven't seen in a long time. Number 5. Ventura. Ventura has long been a California dream, with its laid-back surf scene, postcard-worthy coastline, and friendly, small-town neighborhoods. But even this seaside paradise is starting to feel the weight of the statewide housing slowdown. As of 2025, Ventura's median home price sits around $820,000. After a dramatic run-up during the pandemic-fueled housing boom, prices have started to level off. In fact, over the past year, home values have inched up by just 0.4%, and many experts believe that modest gain could flip into a decline before the year is over. Inventory is telling the real story. Available homes across Ventura County are up nearly 41% compared to last year. Properties in areas like Oxnard, Camarillo, and Inland Ventura are sitting longer than they used to. The average days on market has climbed past 36, and around 33% of listings are now showing price cuts. These aren't huge drops, but they're enough to slow down buyers and open the door for negotiations. Affordability is a major hurdle here. With mortgage rates hovering near 7%, a typical $820,000 home now demands a monthly payment close to $5,600, and that's before you add in taxes and insurance. For many middle-income buyers, it's simply out of reach. And when it comes to insurance, coastal homes are getting hit hard. With the rising threat of wildfires and flooding, premiums have jumped by 20% to 30% in the last year alone. For some homeowners, insurance has gone from a line item to a financial burden. Meanwhile, Ventura's once thriving short-term rental market is losing momentum. As tourism cools and demand drops on platforms like Airbnb, rental income is shrinking. Some investors are cashing out entirely, especially with new local restrictions making it harder to run short-term rentals in certain neighborhoods. Ventura still looks like a dream destination. The charm hasn't disappeared. But beneath the surface, the financial dynamics are shifting. With rising costs, softening buyer demand, and growing inventory, the housing market is clearly cooling off. For now, it's a slow and steady correction, not a crash. But if interest rates remain high and affordability continues to deteriorate, Ventura could be facing a colder market in 2025 than most people expect. Number 4. Oakland. Oakland was once known as San Francisco's more affordable sibling, offering the same breathtaking bay views, sunnier weather, and a slightly less shocking price tag. But in 2025, the party's starting to wind down. Median home prices in Oakland have fallen to around $767,000. That's a 6% drop compared to last year. And while that number alone might raise eyebrows, it hits harder when you realize this same market pushed past the $1 million mark at the height of the 2021 frenzy. Now, values are not just dipping, they're declining at speed. So what's fueling the fall? For starters, there's the tech migration hangover. When remote work became the norm, thousands of Bay Area professionals packed up and left in search of cheaper cities and more space. Now, even as some companies are calling workers back, there's no mad rush to return, and the buyer pool isn't bouncing back. But that's just one piece of the puzzle. Oakland has also faced rising property crime, growing commercial vacancies, and slower than expected economic recovery, all of which are giving would-be buyers serious pause. Then there's the cost to finance. At today's 7% mortgage rate, the monthly payment on a $767,000 home clocks in around $5,400, and that's before you even touch taxes or insurance. For many buyers, that kind of monthly burden just doesn't make sense anymore. Inventory is swelling fast, up nearly 50% year over year, and homes are sitting on the market much longer. In early 2025, nearly 42% of all listings in Oakland had undergone price reductions. Just a couple of years ago, homes here were attracting 5 to 10 offers in days. Now, some sellers aren't getting any. Investor activity has slowed, too. Flippers are pulling back, and first-time buyers are more cautious than ever. Even traditionally popular areas like West Oakland and Fruitvale are seeing sharper price drops, while upscale neighborhoods like Rockridge and Piedmont are holding up slightly better, but still trending sideways. Condos and townhomes, once a hot ticket for millennial buyers, are now stagnating as well. This isn't just a temporary dip. Oakland is experiencing a full-blown market reset. The bubble of the last few years has deflated, and a new reality is setting in, one shaped by affordability concerns, crime rates, and a tech industry that's no longer fueling endless growth. In 2025, Oakland may be one of California's most vulnerable large markets. And right now, for the first time in a long time, buyers are firmly in control, and they know it. Number 3. Sacramento. During the pandemic housing boom, Sacramento was the golden child of California real estate. As Bay Area buyers searched for bigger homes and more manageable prices, Sacramento lit up the map. Between 2020 and 2022, home prices skyrocketed by nearly 40%. But now, in 2025, the momentum has shifted, and the boom is losing steam. Median home prices in Sacramento currently sit around $495,000, down from their peak of about $540,000. That's a 2.5% drop over the past year, and industry analysts say this softening is likely to continue in the months ahead. Inventory is a big part of the picture. Listings have surged by over 46% compared to 2024, and homes that once sparked frenzied bidding wars are now taking 35 to 45 days to sell. About 36% of listings have undergone price reductions, especially in areas like Elk Grove, Natomas, and Rancho Cordova. The sense of urgency that once defined the market? It's gone. Buyers are no longer racing to outbid one another. They're waiting, watching, and negotiating harder than ever. And the real issue isn't just price, it's affordability. With mortgage rates hovering near 6.9%, the monthly payment on a $495,000 home now hits roughly $3,800. For many Sacramento families, that's pushing the financial limit. Unlike tech-driven metros, Sacramento's economy leans heavily on government and healthcare, industries that don't typically produce the kind of wage growth needed to keep up with soaring housing costs. So buyers are hesitating. And let's not forget the Bay Area effect. A wave of remote workers who relocated to Sacramento during the pandemic are now second-guessing that decision. Some are choosing to sell, others are becoming accidental landlords, and many are simply watching as the market starts to slide back to earth. Investor demand is tapering off too. With rental rates flattening and fewer viable Airbnb opportunities, the cash flow just isn't as appealing as it used to be. Flippers and short-term rental hosts are backing away. The good news? Sacramento isn't headed for a 2008-style meltdown. The market is correcting, not collapsing. But for buyers with strong financing and a bit of patience, 2025 could present the best buying opportunities we've seen in years. Just don't expect the return of wild bidding wars and $100,000 over ask offers anytime soon. Those days are behind us, at least for now. Number 2. San Diego. San Diego has always been California's sun-kissed paradise. With its endless coastline, unbeatable weather, legendary fish tacos, and some of the most sought-after real estate in the state. But in 2025, even this coastal gem is starting to cool. The median home price in San Diego now hovers around $875,000. And after years of relentless appreciation, we're finally seeing that upward trend reverse. Over the past 12 months, home values have slipped by about 2.1%. It's not dramatic yet, but with interest rates still sitting high, that decline could accelerate. But the biggest red flag? Inventory. It's exploded, up a staggering 61% year over year. Buyers now have over 6,000 homes to choose from, compared to fewer than 3,800 this time last year. And that's shifting the power dynamic. Sellers are feeling the heat. Nearly 40% of listings have already seen price reductions in 2025, and properties that used to sell in a week are now sitting for more than 40 days. Just 2 years ago, that number was closer to 10. A big part of this slowdown comes down to what economists call affordability fatigue. With mortgage rates pushing 7%, a monthly payment on an $875,000 home can now top $6,000. Even dual-income households are finding it tough to keep up. Consider this. The average household income in San Diego is around $85,000. When you do the math, that kind of mortgage is simply out of reach for a huge chunk of locals, even with good credit and stable jobs. San Diego's job market isn't crashing, but it's shifting. The military, biotech, and tourism industries are still strong, but layoffs in tech-adjacent sectors and declining tourism revenue have started to cool the city's economic momentum. On top of that, new regulations around short-term rentals are making it harder for Airbnb investors to make a profit. Many are backing off entirely, which is adding even more inventory to the market and softening prices further. Now, let's be clear. San Diego is still incredibly livable, and it's not falling apart. The beaches are still here, the tacos are still perfect, and the lifestyle is unmatched. But the real estate party? That's over. 2025 is shaping up to be the first year in a long time where waiting might be smarter than jumping in with both feet. The frenzy is gone. Bidding wars are rare, and buyers finally have room to breathe. We're not calling this a crash, but we are calling it a correction with a tan. Number 1. San Francisco. San Francisco, the crown jewel of California real estate. A city known for its sweeping views, iconic bridges, tech titans, and sky-high home prices that once made it feel completely out of reach. But in 2025, The unshakable is starting to shake. The median home price in San Francisco has now dropped to approximately $1.12 million, a decline of nearly $40,000 since 2024. That's a 3.5% year-over-year drop, with even steeper dips showing up in certain condo markets, especially in fringe and up-and-coming neighborhoods. The Bay Area boom that once put San Francisco on a housing pedestal is starting to reverse. Tech layoffs, a continued exodus driven by remote work, and rising affordability barriers are all putting pressure on the market. Mortgage rates hovering around 6.9% aren't helping either. Even with a standard 20% down payment, buyers are still staring down a monthly payment close to $7,500. And that's before you factor in HOA fees, soaring property taxes, or San Francisco's famously high cost of living. Many would-be buyers have simply tapped out. Inventory is climbing quickly, up 43% compared to the same time last year, and homes that used to get 10, 12, or more offers in days are now sitting for 45 to 50 days without serious interest. Over 35% of listings in the city have seen price reductions, and more sellers are slashing prices in a bid to get offers. Even popular neighborhoods like Noe Valley and Bernal Heights, once considered untouchable, are starting to see markdowns. And condos, which were once snapped up by young tech professionals, are now languishing on the market. Much of this can be traced back to remote work. Many former SF residents have relocated to cities like Boise, Austin, or Sacramento, where $1 million buys a spacious home with a yard, not a compact one-bedroom walk-up. And as more people find they don't have to live near the office, the urgency to buy in San Francisco has faded. Then there are the quality of life concerns, a harsh reality that's pushing even longtime residents to rethink their future in the city. Issues like homelessness, public safety worries, and transit frustrations continue to make headlines and chip away at the city's appeal. Now, to be clear, San Francisco isn't going to collapse. It's still a global city, a cultural hub, and a major player in tech and finance. But that sense of invincibility? It's gone. The glow has dimmed. And for the first time in years, buying real estate in San Francisco doesn't feel like chasing a unicorn. It feels possible. If you've been waiting on the sidelines, hoping for a chance to own a piece of this iconic city at a more reasonable price, 2025 might just be the year it finally happens.